When you hear the words investment banker, your brain probably short circuits with flashing images of Wolf of Wall Street lunacy, Lamborghinis, champagne, some dude named Chad screaming into two phones while throwing back espresso shots at 3 a.m. They seem like the apex predators of capitalism, the ones pulling strings behind billion-dollar deals, raking in six-figure bonuses while casually destroying economies on lunch breaks. But here's the twist. Most investment bankers, especially the junior ones, spend their days in poorly lit conference rooms making PowerPoint slides for clients who will never read them. It's less cocaine and hookers, more Excel and herniated discs. Let's talk about the lie. Investment banking to the outside world is sexy. It's got prestige. It's got the I went to Harvard and now I'm morally grey energy. It's the job every finance major flexes on LinkedIn with a humble brag like, thrilled to be joining Goldman Sachs as a summer analyst. Hashtag blessed. Hashtag grind time. In movies, bankers are suit-wearing alpha types, closing deals between sips of 30-year-old scotch. In reality, most are barely surviving off room temperature Red Bull and wondering if their Wi-Fi will hold long enough to send another version of a pitch deck before midnight. If you've ever Googled, what is investment banking, and felt more confused than before, you're not alone. Most explanations sound like this. Investment banks advise companies on mergers, acquisitions, capital raising, and corporate strategy. Cool. That tells us exactly nothing. Here's the real translation. A company wants to buy another company, but doesn't know what it's worth. Call the bankers. A startup wants to go public, but has no idea how to price shares. Call the bankers. A CEO wants to feel important by hiring someone to make a 200-page presentation to show shareholders their exploring options. You guessed it, call the bankers. Investment bankers are the professional middlemen of money. They don't make stuff, they don't sell stuff, they move money around and charge millions to do it. If you're a junior, usually called an analyst or associate, your daily life is a never-ending Groundhog Day of making pitch books, fancy PDFs with graphs and jargon no one reads, updating Excel models until your wrists revolt, sitting on muted Zoom calls while wondering if this is really worth 175k a year and your soul. Think you're done for the day? Think again. Your VP sends you an email at 11:47 p.m. Hey, can you just tweak slide 78 real quick? Need it for a meeting in 6 hours. Thanks. Your reward? A $20 seamless voucher and the chance to expense an Uber ride home, assuming you ever leave the office. Now, let's address the elephant in the room. The money. Yes, entry-level bankers make 120k to 150k base salaries right out of college. Add a bonus, and you're clearing 200k in your early 20s. But don't let that distract you from the fact you're averaging 80 to 100 hours a week. Break that down, you're getting paid like a doctor, who's also a hostage. They don't give you that money because you're smart. They give it to you because you work until your eyeballs twitch, you don't ask questions, and you deliver a 97-slide deck on retail synergies while internally questioning your entire existence. So, to recap, people think investment bankers are glamorous deal makers. They're mostly just overpaid interns with better fonts. Entry-level roles are glorified spreadsheet torture with prestige perfumes sprayed on top. You work absurd hours for rich clients who forget your name 30 seconds after you leave the meeting. But the money, just enough to make you ignore the pain and think, one more year can't hurt. Spoiler, it always hurts. If you've made it this far without rage quitting your finance dreams, respect. Now, hit that like button so the algorithm knows you're smarter than the average LinkedIn humble bragger, and subscribe for more brutally honest breakdowns of the world's most overpaid careers. Now that we've peeled back the Armani-centered illusion, let's get into what investment bankers actually do. Spoiler, it's not insider trading on yachts. Well, not publicly, at least. At its core, investment banking is about helping companies move huge amounts of money around, either by buying things, selling things, or raising more money from other rich people. The three pillars of modern investment banking are merger and acquisitions, capital raising, advisory, aka expensive opinions dressed up as strategy. Let's break that down into real words. When Company A wants to buy Company B or merge with Company C to unlock synergies, translation, fire a bunch of people and double the stock price, they call in the bankers. M&A is where the most money is made and lost. Example, Facebook buys Instagram, $1 billion. Amazon buys Whole Foods, $13 billion. AOL buys Time Warner. Disaster. The banker's job is here to find the right targets or buyers, negotiate prices, handle the legal and financial spaghetti, and pretend it was their genius idea all along. They get paid a success fee, which can be tens of millions. Even if the company tanks after the deal, bankers still get paid. It's like being a wedding planner who walks away with the check even if the marriage ends in flames. Let's say a company wants more cash to expand. They can either sell part of the company to the public, take on debt, or do some funky hybrid Frankenstein thing like a convertible note. That's where the investment banker becomes a financial matchmaker. They package the company into a shiny presentation, pitch it to wealthy investors, hedge funds, or pension funds, and collect a fee for doing so. Example, Airbnb IPO. Bankers earned $100 million in fees. Tesla's many capital raises. Each one lined a few more pockets on Wall Street. It's like crowdfunding, but instead of t-shirts and keychains, you get preferred stock and voting rights, and hopefully no prison time. Finally, there's advisory work, the most vague, mystical part of investment banking. This is when a CEO wants to feel fancy and tells shareholders, "We've hired a top-tier investment bank to explore strategic alternatives." Translation: we have no idea what we're doing, so we're paying someone $10 million to make a pretty PDF. The bank will analyze market conditions, evaluate acquisition options, and produce a 200-page pitch book. Does it change anything? Not really. But it gives the illusion of motion, which is sometimes more valuable than the motion itself. Here's the game. Investment banks don't get rich from salaries, they get rich from fees, and more fees. Typical fee structure: merger and acquisitions, 1 to 2% of the transaction size, IPO, 4 to 7% of the total raised, and advisory, a flat fee plus a bonus and lunch if they're lucky. So, if you help a company raise $500 million in an IPO, your bank might take $25 million just for brokering the intro and running a few spreadsheets. Welcome to the money printing machine. Not all banks are created equal, but here's the power tier list. Bulge bracket banks, the big boys. Goldman Sachs, JP Morgan, Morgan Stanley, both for Merrill Lynch. These guys do everything, everywhere, all at once. Boutique banks, Lazard, Evercore, Moelis. They're smaller, merger and acquisition focused, and often pay even more, but expect blood. Bulge bracket gets you brand recognition. Boutique gets you quicker promotions, sharper knives, and slightly less corporate Kool-Aid. Welcome to investment banking, the corporate equivalent of Navy SEAL training, but with more spreadsheets and slightly fewer push-ups. Fun fact, investment banking has one of the highest turnover rates in finance. You'll hear things like, "Sure, you're working 90 hours a week and losing hair, but that 80K bonus is going to hit hard." Let's break it down. Analyst base salary, 125K. Bonus can range from 30 to 100K depending on performance, firm, and how well you tolerate verbal abuse. Here's the trick. That bonus isn't guaranteed, it's discretionary, meaning it depends on your performance, the bank's revenue, whether your VP was in a good mood that week, the color of your PowerPoint template. Not joking. And don't forget, 40% of it might get taxed or paid in deferred stock. The path looks like this. Analyst, years 1 to 2, human printer. Associate, 3 to 4 years, managers analysts, gets yelled at more politely. VP, 5 and 7 years, part middle manager, part therapist. Director/ED, starts to bring in clients. Managing director, closes deals, owns suits more expensive than your car. The higher you go, the more you do actual client-facing stuff. The lower you stay, the more you're just formatting fonts and fixing typos. But here's the problem. People burn out, people quit, people exit to private equity, hedge funds, fintech, or therapy. Which leads us to the biggest lie sold to investment banking juniors is this. Just grind it out for 2 years and the world is yours. Let's recap. They sell money. They're brokers for billion-dollar ideas, facilitating mergers, IPOs, and strategy memos no one reads. They grind. 80 to 100-hour weeks, endless slide decks, internal politics, performance reviews, and managing up while being emotionally down. They burn. Out of energy, out of time, and often out of reasons to stay, but not quite out of cash. They exit. If they're lucky, or they double down, climb the ladder, and one day become the MD screaming for changes to a deck at 2 a.m. Investment banking is capitalism's meat grinder. Prestigious, profitable, and soul splintering. It's not for the weak, the disorganized, or anyone who enjoys sunlight. But if you can survive it and play the game right, you might just escape with enough money, status, and stories to dine out on for years. Just hope you still have friends left to tell them to. Still want to become an investment banker? You're either built different or deeply unwell. Either way, smash subscribe so you don't miss the next episode, where we expose more high-paid jobs that secretly destroy your will to live. And yeah, like the video. It's the only bonus I'm getting this year.